The U.S. Securities and Exchange Commission, or SEC, stands as the primary regulatory body overseeing the vast and complex landscape of the American financial markets. Established in the wake of the 1929 stock market crash, the SEC's core mission is to protect investors, maintain fair and orderly markets, and facilitate capital formation. Its regulatory reach extends across a broad spectrum of financial instruments and institutions, including publicly traded companies, investment banks, brokerage firms, and investment advisors. The SEC's regulatory framework is designed to promote transparency, fairness, and accountability within the financial system. It requires companies to disclose material information to investors, prohibits fraudulent and manipulative practices, and sets standards for professional conduct among market participants. By enforcing these rules and regulations, the SEC aims to instill investor confidence and ensure the integrity of the markets. The SEC's role is crucial for fostering a stable and efficient financial system. Its oversight helps to mitigate systemic risks, prevent market abuses, and protect investors from unfair or deceptive practices. In essence, the SEC acts as the watchdog of Wall Street, safeguarding the interests of investors and the integrity of the markets as a whole. Sanctions represent a critical component of the SEC's enforcement toolkit, serving as a powerful deterrent against violations of securities laws. These penalties can take various forms, ranging from financial penalties to industry bars and other remedial measures. The severity of the sanctions depends on several factors, including the nature and extent of the violation, the harm inflicted upon investors, and the level of cooperation exhibited by the wrongdoer. Monetary penalties are a common form of SEC sanction, often imposed on individuals and corporations found to have engaged in fraudulent or manipulative activities. These fines can reach substantial sums, designed to deprive wrongdoers of any ill-gotten gains and deter future misconduct. In some cases, the SEC may also seek disgorgement, requiring wrongdoers to relinquish profits earned through illegal activities. Beyond financial penalties, the SEC may impose industry bars or suspensions on individuals or firms found to have violated securities laws. These bars can prohibit individuals from serving as officers or directors of public companies or engaging in certain securities industry activities. Such sanctions aim to protect investors by removing bad actors from positions of trust and influence within the financial markets. Over the past decade, the SEC has brought numerous enforcement actions against investment banks for a wide range of violations. These cases have involved market manipulation, insider trading, accounting fraud, and failures to disclose conflicts of interest. Notable cases include JP Morgan's $920 million settlement for the London whale scandal and Goldman Sachs's $5.1 billion settlement for mortgage-backed securities fraud. In 2021, the SEC charged Archegos Capital Management with market manipulation. These cases underscore the SEC's commitment to holding investment banks accountable. The SEC's enforcement actions against investment banks over the past decade reveal several recurring themes and underlying motives that have prompted regulatory scrutiny and sanctions. These common threads shed light on the persistent challenges in regulating the industry and the areas where firms have repeatedly fallen short of their compliance obligations. One prominent theme is the pursuit of profit at the expense of ethical conduct and investor protection. In many cases, the SEC has found that investment banks prioritize their own financial gain over their fiduciary duty to clients, engaging in deceptive practices, concealing material information, or putting their own interests ahead of those they were obligated to serve. Another recurring issue is the lack of adequate internal controls and compliance procedures. The SEC has repeatedly found that investment banks have failed to implement robust systems to prevent, detect, and address potential violations. Moreover, conflicts of interest have emerged as a persistent problem within investment banks. The SEC has brought numerous actions against firms for failing to manage or disclose conflicts that arose from their various business lines and relationships. The SEC's sanctions against investment banks can have far-reaching consequences, impacting not only the institutions involved, but also the broader financial markets and the overall economy. For the banks themselves, SEC sanctions can result in significant financial penalties, reputational damage, and a loss of investor trust. The imposition of hefty fines can impact profitability and shareholder value, while negative publicity can tarnish a bank's brand and make it more difficult to attract and retain clients. The loss of investor confidence can lead to a decline in share price and make it more expensive for the bank to raise capital. Beyond the direct impact on the sanctioned banks, SEC enforcement actions can send shockwaves through the financial markets. News of a major settlement or penalty can spark market volatility as investors reassess the risks associated with the industry or specific firms. This uncertainty can lead to a decline in trading activity and make it more difficult for companies to raise capital, potentially hindering economic growth. Furthermore, SEC sanctions can have a broader impact on market practices and industry standards. When the SEC takes action against a firm for a particular type of misconduct, it sends a clear signal to other market participants that such behavior will not be tolerated. The SEC's enforcement actions serve as a powerful reminder that non-compliance with securities laws comes at a steep price. By imposing significant penalties and other sanctions, the SEC aims to deter future misconduct and foster a culture of compliance within the financial industry. This deterrence effect is crucial for maintaining market integrity and protecting investors. The SEC's commitment to enforcement sends a clear message that it will not hesitate to hold firms and individuals accountable for their actions, regardless of their size, influence, or political connections. The SEC's enforcement efforts also have important implications for the future of the financial industry. As technology continues to transform the markets and new products and services emerge, the SEC will need to adapt its enforcement strategies to address emerging risks and challenges. This will require ongoing investment in technology, data analytics, and specialized expertise. While the SEC primarily focuses on U.S. markets, its enforcement actions have increasingly extended beyond American borders, reflecting the interconnected nature of the global financial system. The SEC's pursuit of cross-border violations has significant implications for international firms operating in the U.S. and highlights the agency's commitment to holding all market participants accountable, regardless of their domicile. The SEC's extraterritorial reach is rooted in its mandate to protect U.S. investors and markets, even when the misconduct originates outside the country. If a foreign entity's actions have a substantial effect on U.S. investors or markets, the SEC may assert jurisdiction and pursue enforcement actions. This principle has been applied in numerous cases involving insider trading, market manipulation, and other violations involving foreign entities. The SEC's cross-border enforcement efforts have been bolstered by its active participation in international organizations, such as the International Organization of Securities Commissions, or IOSCO. Through these forums, the SEC collaborates with its counterparts worldwide to share information, coordinate investigations, and develop harmonized regulatory approaches. This cooperation is essential for addressing cross-border financial crime and promoting a level playing field for all market participants. However, the SEC's extraterritorial reach has not been without controversy. Some critics argue that it can create uncertainty for foreign firms operating in the U.S. and potentially discourage foreign investment. Balancing these concerns with the need to protect U.S. investors and markets remains an ongoing challenge for the SEC. The SEC's enforcement actions have undoubtedly played a crucial role in deterring misconduct, improving market integrity, and protecting investors. However, there is always room for improvement in promoting transparency, accountability, and fairness within the financial industry. Several measures could further enhance the SEC's effectiveness and strengthen its ability to fulfill its mission. One area for improvement is increasing the transparency of SEC investigations and enforcement actions. While the SEC has made progress in recent years in providing more information to the public about its activities, there is still a lack of clarity regarding its decision-making processes and the rationale behind its settlement agreements. Greater transparency would allow for greater public scrutiny of the SEC's actions and help to ensure that it is applying its enforcement powers fairly and consistently. Another area for improvement is enhancing the accountability of individuals involved in corporate misconduct. While the SEC has increasingly pursued charges against individuals in recent years, there is still a perception that Wall Street executives are often able to avoid personal liability for corporate wrongdoing. Strengthening the SEC's ability to hold individuals accountable would send a strong message of deterrence and promote a culture of personal responsibility within the financial industry. The SEC's enforcement actions over the past decade have left an indelible mark on the financial industry, shaping a more responsible and accountable landscape for investors and market participants alike. By holding firms and individuals accountable for their actions, the SEC has fostered a greater awareness of compliance obligations, strengthened risk management practices, and deterred future misconduct. The legacy of these enforcement actions extends beyond the specific cases themselves. They have prompted broader reforms, improved industry standards, and fostered a greater appreciation for the importance of ethical conduct and investor protection. The SEC's unwavering commitment to enforcement has played a pivotal role in restoring public trust in the financial system following the 2008 crisis and creating a more resilient and sustainable market environment. However, the work of the SEC is far from over. As the financial industry continues to evolve and new challenges emerge, the SEC must remain vigilant in its enforcement efforts, adapting its strategies and resources to address emerging risks and protect investors. By continuing to prioritize enforcement, promoting transparency, and fostering accountability, the SEC can build upon its legacy of protecting investors, maintaining market integrity, and ensuring that the financial system serves the best interests of all stakeholders.